Value versus growth. Which of the two belong in your portfolio? Now, we're going to do a deep dive on the differences between the Vanguard Growth ETF, symbol VUG, and the Vanguard VTV, which is their value fund, and see what the difference is between the two of them, how they performed, and what is under the hood. Now, here is a 8-year chart of the Vanguard VTV Value Fund. It pays almost a 2% annual dividend stream, and you can see it's done extremely well since the last spring, or probably since June of 2025. It's performed really well. But let's take a look and see what's under the hood of the value fund. Here we can see you have JP Morgan, Berkshire Hathaway, ExxonMobil, Johnson& Johnson, Walmart, AbbVie, Home Depot, and all the brick and mortar businesses and the foundational businesses that we are familiar with. They're not flashy, but they provide stable growth and they're a huge part of the economy. They're typically healthcare stocks, banking stocks, energy stocks. And again, they're not always flashy, they're not always sexy, but they perform and provide a great rate of return. Here is the Vanguard VUG Growth Fund. Now you can see since the same time that value began to pick up, growth began to sell off, right? So let's take a look and see what's inside and under the hood of the VUG Vanguard Growth ETF. NVIDIA, 13.23% stock weighting in this ETF. So 13% of this ETF is just NVIDIA. NVIDIA, Apple, Microsoft, Google, Amazon, Facebook, Broadcom, Tesla, Eli Lilly, Visa, Netflix, Palantir, Oracle, which has gotten crushed lately, by the way. These are the reasons why the growth has performed poorly in the last few months. And so what I want to really bring to your attention is this: the VUG Vanguard Growth Fund only pays about a 0.46, but you're buying the future, you're buying expansion, you're buying the sexy stuff. And one performs better when risk is on, markets aggressive, interest rates are declining, or risk is off, like we saw after in 2022 when Jerome Powell began raising interest rates. But here's the thing I really want to share with you what I find interesting. And that is, if you take a look at the relationship between the two, growth versus value, you're going to see in this chart, which is an old school point and figure chart, X's mean demand, O's mean supply. And so this gets rid of all the noise. It's not candlestick charting. All it does is really determine the basics, properties of supply and demand. You can see that when it's in X's, growth is outperforming. When it's in O's, value is outperforming. And this is the thing I really want you guys to keep in mind while you're investing and you have a lot of time ahead of you, is that if you can play one off the other, in other words, if you're a little bit sensitive as to what part of the economy, what part of the economic cycle we are in, what part of the 4-year cycle, are we in expansion or are we in contraction? Are we in aggressive growth and risk on, or is it time to play defense? If you can play one off the other, your returns can be outsized as compared to the individual components. So we're not talking about market timing. We're just here to talk about if you can determine which part of the economic cycle that we are in. Are we in growth, peak, decline, or trough, which is like the sideways action? You can perform, your portfolio can perform much, much better by just leaning a little bit one way or the other. And if you have any questions, if you consider yourself a value investor or a growth investor, leave a comment in the section below. Let me know whether you like growth or whether you like dividend paying value. And again, we're not asking you to time the market. We're just asking you to be a little bit more cognizant, a little bit more aware of where interest rates are going, what's happening in the economy. And if you keep an eye on the value versus growth, I think you'll be able to tilt your portfolio like a teeter-totter, right? And to potentially provide outsized gains over a lifetime of investing.